Holy flippity flip flop flapping smokes, everyone! The Japanese yen is collapsing along with the Japanese economy, and because Japan is the largest holder of US treasuries, US government debt, we need to pay big attention to this right now. Because what's been happening lately is Japan's central bank has been going against all other central banks around the world. While other central banks around the world have stopped their money printing, have started quantitative tightening, they've started lifting interest rates, well, Japan's central bank is still money printing like crazy. They announced today they're going to be doing unlimited bond buying and they're trying to keep interest rates anchored at zero. But now they're starting to face inflation that they haven't seen in decades because Japan has had a problem of not enough inflation, or they've even struggled with deflation for the past couple of decades since their huge bubble burst in the 1990s. So everyone, what's really going on with Japan? What consequences does this have for us around the world? Well, that's exactly what I'm going to get into in today's video. So let's not waste any time, ladies and gentlemen. Let's get straight into the news, the facts, and the data. Well, holy smokes, everyone. Look at this. Yen weakens past 150 per dollar for the first time in 32 years. But Michael, when's the crash going to happen, man? What the heck have you been looking at the past 6 months? Can't you see currencies around the world are collapsing rapidly? We're seeing currencies more volatile than Bitcoin right now. So I don't know what more proof, what more data I need to show you. Things are getting very serious right now, little Jimmy. Oh yeah, I guess so. Now again, people, why we need to pay attention to this as investors in the US, Europe, Australia, etc. is because Japan is the largest holder of US treasuries in the world. That's right. More than the UK, more than China. Have a look at this chart, everyone. Look at this. This is the largest major foreign holders of United States Treasury securities as of July 2020. Now we can see here, Japan absolutely dwarfs everybody with $1.2 trillion worth of US Treasury yields. Then we've got China. Then we've got the UK at 600 billion. So again, they're double what the UK is, and you can see the list goes on and on. They don't come anywhere close to any other country to Japan. Well, have you been watching the yields on the treasuries lately? The 10-year is nearly at 4.2%, and the 2-year is at 4.6%. So bonds are crashing right now. And who do you think is crashing this market, everybody? It is Japan, because what they have to do to shore up their currency is they have to sell bonds, US bonds, so they can get US dollars, so they can sell those dollars to buy yen. That way they try to keep the dollar in check while they're trying to create artificial demand for their currency. But it's not working, everybody. Again, this is the worst currency devaluation in 3 decades, so it's time to pay attention. Now you may be wondering what's behind this huge currency devaluation. Well, let's dig a bit deeper. Look at this, everyone. BOJ announces unscheduled bond buying program as key yield broke ceiling. So what the Central Bank of Japan is doing, something like the Reserve Bank of Australia did during 2020 and 2021, is something called yield curve control. That's where they buy up the bonds to keep the yield on those bonds at a certain point. And right now, they're trying to keep yields at zero. So that's right, Japan can't even afford for interest rates on these bonds to go to 0.5%. That's what happens when you print unlimited money. That's what happens when you try to use modern monetary theory, where they say you can just print any amount of money you want with zero consequences. Well, Japan is about to pay the price, and they could bring the rest of the world down with them. Japan's benchmark yield climbed above the central bank's policy ceiling, and monetary authorities announced unscheduled bond purchases to rein it back in. So when other central banks are selling bonds, Japan is buying bonds. When inflation is getting out of control and other central banks are trying to rein it in, well, Japan is going to let it run hot. Now, Japan hasn't suffered high inflation yet, but with the new latest data, we can see the trend to Japan inflation is starting to rise. Look at this. Now you may think this is not much, 3%, but Japan has had deflation for decades, and it rose 0.4% from a month ago. So when you annualize that, and when it compounds, Japan could be hitting an inflation rate of 5% very soon. And we all know the real inflation rate's much higher than this. Japan has tried to say they've had no inflation for decades. Really, they're trying to cover it up. If you go to Japan, you'll see things are very expensive. Look at this. The yield on the 10-year note briefly rose 0.5 basis points to 0.255% Thursday as the Bank of Japan held the first unscheduled bond buying operation this month. Global yields have continued to march higher as traders increase their expectations for peak Federal Reserve policy rates. So that's right, everybody. The Bank of Japan is panicking because rates went to 0.25%. And you better believe during the next market crash, other central banks are going to follow suit. and it's going to lead to a complete disaster. The Bank of Japan plans to buy 250 billion yen, $1.5 billion of bonds ranging from 5-year to longer dated debt. It separately offered to purchase an unlimited quantity of 10-year notes at a yield of 0.25%. So again, everyone, this is crazy. When inflation is getting out of control, they're literally saying, we'll print unlimited amounts of money. Does this give you confidence if you live in Japan in your currency? I'd think not. The rise above the Bank of Japan's yield ceiling underscores deep-rooted speculation in the market that would have to tweak its yield curve control policy, which looks increasingly at odds with other central bank peers. While the nation's still anemic growth prospects argue for continued policy accommodation, rock-bottom interest rates have driven the yen to a 32-year low, boosting imported inflation for both consumers and businesses. And people, this isn't just happening in Japan. This is happening with the euro. We're seeing the euro is now below the dollar. We're seeing the pound has crashed. We're seeing the Australian dollar has crashed. This is what I've been warning about. With the Federal Reserve lifting interest rates, all other central banks are going to have to follow suit, or their currencies are going to collapse. And when currencies collapse, that's what really makes inflation turn into hyperinflation, because it makes all imports much, much more expensive. And now Japan is suffering a huge trade deficit. Look at this, Japan's extended trade gap reinforces pressure on tumbling yen. So Japan's trade gap extended its longest streak of red ink since 2015, as the weaker yen pushed up the import bill, an outcome that will weigh on the economy and feed back into further currency weakness. Again, if you're watching this in Europe, Australia, UK, etc., you're all going to face the same problem. And look at this chart here, another red month. Japan experienced 14 consecutive months of trade deficits amid historic yen fall. While increased shipments to China and the US and Europe is good news for Japan's big exports, the prolonged trade shortfall will weigh on Japan's recovery from the pandemic. The deficit will drag on economic growth, while soaring import costs for energy, food may amplify the impact by slowing domestic consumption. The continued shortfall will also reinforce weakness in the yen that further complicates Japan's economic outlook. People, if Japan doesn't stop this yield curve control policy and doesn't stop this unlimited money printing, their currency is going to collapse further and further and further. And like I said, this is going to be big trouble for the US, because they're going to have to start dumping more and more of those US treasuries. That's going to make yields on bonds go higher. And when yields on bonds go higher, this is going to crash the stock market and real estate, because we're seeing mortgage rates in real estate right now getting close to 8%. Was interest rates people told me would never happen. And now we're starting to see a few Fed officials admit they're going to have to take interest rates to 5%. Now back to Japan. To counter the impact on companies and consumers, Japan is complying an additional economic stimulus package this month, including support for households hit by accelerating inflation. Oh my goodness, people. These governments just keep making the same mistake over again and again and again. They're literally doing insanity. What has caused this inflation? It's been uncontrollable money printing and uncontrollable government debt. So their solution for higher prices is to give more money to create more demand when there's low supply. That is just throwing fuel on the fire, everyone. We saw what happened to the pound when the UK government tried to announce more stimulus, and now the same thing has happened to Japan. Investors are selling their currency. A second extra budget that will help fund the package will reportedly include 10 billion yen in subsidies to help companies boost their exports in an effort to take advantage of weak yen. Prime Minister Fumio Kishida has also said he'll launch relief measures to counter raising electricity bills early next year. He said gasoline subsidies will also be maintained beyond January, and relief on natural gas bills will also be introduced. Again, people, printing more money, giving out these stimulus, that's just like throwing a piece of paper over the problem. It's not fixing the fundamental issue, low supply. What they need to do is invest and create more and more supply. This is only going to make the energy crisis in Japan and around the world much, much worse. We may think this is the worst of it and it can't get worse from here. While some analysts are saying now that it could actually get even worse than this. The yen has wiped out last month's intervention-driven gains, despite the government confirming an almost 20 billion spend and unleashing a barrage of warnings to dissuade traders from testing its resolve. It has tumbled 23% against the greenback this year, as traders focus on the widening yield differential between the US and Japan, which favors dollar assets. So what this means is, everybody, their interventions are no longer working. Eventually the problem is going to get so bad that they won't be able to fix it. And look at this, their currency is down 23%. Again, this is more volatile than some cryptocurrencies. So here's what some analysts are saying how weak the yen could get. Given the upward trajectory of US bond yields, a dollar yen at 160 in coming months is not out of the question. Okay, everyone, so I know what you're thinking. Well, okay, what does all this economic jargon, what does all this Forex jargon mean for you in simple terms? What this means is, everybody, central banks around the world, they're going to have to follow the Fed, start hiking interest rates whether they like it or not. If they don't, the currencies are going to crash, inflation in their countries are going to get worse, and this is going to have ripple effects throughout the rest of the world as highly indebted corporations in these countries that thought interest rates would stay lower, well, they're going to start defaulting on their debt. And what they're simply doing is sacrificing their currency to try to save the markets. And this is destroying people's purchasing power. And that means people in these other countries, they're having to work 20% more just to have the same amount of purchasing power. So everyone, what do you think about this? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.